Rohit Agarwal is joining us from Kotak Mahindra Life Insurance. Let's touch base with him. Rohit, hi, good afternoon and a happy new year to you and the entire team at Kotak. Just want to start by addressing the auto pack. The numbers have been extremely disappointing this time around. The estimates by the street were very cautious, and despite that, there's been a miss. Is it likely to be a trend for 2019, or do you see things stabilize?
Hi, good afternoon and a happy new year to everyone. Well, the reasons for auto slowdown is not something to do which has happened this month, but the genesis of it lies into what happened just before the festive season happened, where most of the OEMs had given or pushed inventory to their dealers, and at that time, if you remember, crude oil was above $80. That was a sentiment dampener to start with. And that's the time where the NBFC liquidity issue kind of hit the market. These two issues just changed the whole dynamics of the game, and the sales that were supposed to happen in the festive period did not happen. Now, it is not possible for the industry to reverse that loss because that is a permanent loss. If the festive season is gone, the consumer is not going to come back and again demand for that bike or a car which he has not purchased, because it's a sentimental value. People do tend to purchase during the festival period. Some of that headwinds have started to recede, but at the same time, the demand knock which had taken place or the sentiment which has changed will take little more time to come back. So for 2019, we expect the first half, especially the last quarter or the first quarter of 2019, again not to be great for the auto companies in terms of sales numbers, because they are already sitting with high dealer inventory. Some of the dealer inventory has been cleared, as we understand, during December, but there is more to go. What we have to also keep in mind that the whole industry, especially say the two-wheelers, have seen cost increases which are massive. The cost increase for insurance came in for two-wheelers again just before the festive season. Now there is going to be a cost increase for increased safety enhancement, and then at the end of the year you have probably got BS6 coming up. So you have another about high single digit kind of cost increases that you're looking at for the auto industry. In that scenario, typically it is very difficult for the industry to do very well. And I'm talking about, say, especially the two-wheeler commuter segment. In that segment, which is very, very price sensitive, it is very difficult that a price cost or cost increase of 10 to 15 to 20% kind of gets absorbed very easily. So to answer it in a nutshell, we do not expect great numbers from the auto industry as a pack into 2019. However, there will be a few silver linings. For example, it might so happen that given the expectation that the government is likely to do something for the Indian farmers, we read about it in the newspapers and we get the media bites as well, that there are quite a few options on the table for the government regarding that. If anything of that were to come through, you would probably see some kind of an uptick, especially in the rural side, where maybe a tractor or an MHCV will probably start to look a little better.
Right.
But overall, I don't think 2019 is something you should expect great numbers from the auto industry.
Okay, so don't expect much when it comes to 2019. And yeah, only if there's sort of a rural impetus for, by the government is when perhaps you could expect a leg up for tractors, etc. Rohit, let's talk about the markets now. Volatility has been the name of the game for the markets, for the benchmarks, at least in 2018. And you as well believe that it's global cues really that have dominated the market move. Do you think that trend is going to continue, where global factors are, if the global markets catch a cold, it's India that's going to sneeze? Do you think that's going to be the scenario even in 2019?
Well, pretty much close to that, if not going to mirror what's happened. See, in the last 15 to 20 days or so, certainly the whole world has become worried about the growth at large. People are now expecting recession 1 year down the line. That wasn't even in our conversations a quarter back. That's how quickly things change. Now the Fed dot plot, which talks about rate increases going into next year, the market is assuming that probably it was the last Fed rate hike that they have done, whereas the Fed themselves believes another 2 or 3 to go. So if global cues are not very supportive, which essentially means global growth tapers off by 30 to 50 basis points, give and take, what it means is the commodities as a pack will not see too much of euphoria. Now when that happens, it is advantage India. But we have to keep in mind that it is very unlikely that if global markets fall 15-20%, we go up. We'll probably outperform in a global market where global growth slows down at the margin and commodity prices are under pressure or in check. That's advantage India. Then you come back to the Indian conditions of how earnings and growth pan out, and add to that the political volatility that you'll have during May elections. So I think especially in the first half till elections, we'll be more guided by the global events. After that, if global events remain or come out to be true as we expect, where they slow down a little and commodities remain under pressure or stay where they are, it's back to the Indian earnings story, which if you see in the last 2 quarters has actually not been that bad, and the last quarter for sure was actually a little better than the street estimates. And given the cycle being turning on the corporate side and on the capex side in India, we might see the Indian earnings touching high teens or close to 20%. And if that happens, Indian markets will likely outperform in the second half, most likely.
Okay, you are talking about consumption and private corporate lenders as your top bets. Is it primarily because we're in the election year and these are the stocks that typically tend to react positively, or do you see more fundamentals and more triggers in place to aid growth?
Well, for the private banks, it's probably got nothing to do with the elections. Where you see, because of the AQR exercise undertaken by the RBI, in the last year or so, practically a lot of the mess which was hiding behind has come to the fore. And if you see, we are probably up for a corporate revival of sorts. Now, what we expect is, in the corporate side of the private banks for sure, some of the NPA recognition will start to slow down. Whereas if you see in the last year, the credit cost for the pack as a whole was anywhere between 200 basis points to 400 basis points. Now that's pretty much more than the kind of ROAs a private bank makes. Now if this 200 to 400 basis point comes down or compresses to 100 to 200 basis points, that's a straight 100 to 200 basis points impact on the ROA. And even if you assume only 50% of that is retained, you are going to probably see significant earnings acceleration. So the private banks, it's more to do with the cycle, which we believe on the corporate side it is turning. On the consumption side, if you see, India is primarily still a consumption driven economy, and given the elections coming through happening in May, and the government very clear that they want to do something for the rural sector, they are clear to dole out in some form or the other. We don't know how, but whatever they do, it is trying to do something for the people, for the farmer of the rural India. And if they get money in some form or the other, it is likely that they will spend on consumption. So the rural stories which are consumption led are the kind of ones that we still believe will continue to do well in the near term.
All right, Rohit, we leave it at that. Thanks so much for joining in and giving us your perspective for 2019 and, of course, the sectors that one must watch out for.